view. I was just going to touch on 4 points. I don't want to steal the thunder of our very distinguished panel. So I'll just pick up on it, and then we can discuss any questions you may have at the end. The first one I was going to pick up on is around deal flow, which is a much talked about topic for all of us. As Richard mentioned, when PropertyEU ran a similar event last year, we said that the indicators were positive and that the market was starting to gather some momentum. But there was still some nervousness, I think, in the room as to whether the floodgate would really open and whether all the capital that had been raised would find home. Well, it's fair to say that 12 months on, a lot has happened. There are many more deals that have been done, many more on the block, and many more that we can see coming. The NPL market, which is just one small corner of the market, but just to help me illustrate the point, in terms of numbers, if you look at UK and Ireland, 2013, we saw about 7 billion sterling of loan balances transacting, and that's purely commercial real estate. 2014, first 5 months, we had in excess of 20 billion of loan balances transacting. Now, for those of you that follow that market, you're going to tell me all of that is IBRC. You're right, IBRC is a significant component of it, but even if you exclude that, you're about 6 billion, and we're 5 months in. So it's a small component of the market, but there's a lot more. The second point, I think, on deal flow is, whilst we started with primarily a UK market going into Ireland, I think now we have a true pan-European market. Deals have been done in Germany, deals are starting to happen in Spain, Italy is opening up, the Netherlands is setting up a bank. On the whole, there is a lot more going on and many more markets opening. And I think that's keeping many more of us quite busy. So I'm sure we'll touch on that a little bit more in the panel discussion, but on the whole, a lot more going on. The second point I was going to touch on is pricing. Now, I think everyone recognizes here that pricing is somewhat different than it was a year ago. I think, generally speaking, in all the corners of the market, prices have gone up. Why they've gone up, I think we all have our own view on that. Better economic fundamentals, some signs of improvement in the occupier market, some investors chasing yield in a low interest rate environment. All of that, I think, is valid, and we can debate into how much of that counts. The 2 points, I think, is around cost of capital. Equity IRR and underwriting criteria have, I think, tightened. It's probably fair to say. The traditional expectation of funds and real estate private equity funds that 20% IRR, 2 times equity multiple, that's not the requirement out there. We're talking mid-teens, we've seen low teens, and equity multiple starting with a 1, and not big digits after that, depending on the transaction and the risk profile. So that's got tight. And the push for that is mainly driven by the fact there is a lot out there, and there is a push to get it out. The second component is debt. I think that's quite a striking difference compared to 12 months ago. There is a lot more out there. There are many more institutions lending, they are going up the risk profile, pricing has come down. That's for asset financing as well as loan-on-loan financing. Has been a driver to price. I think that's also been a driver in terms of market capacity. So some of the bigger portfolios that we've seen transacted, I think there is a question mark as to whether it would have been possible if the debt wasn't there, at least not in the same quantity as it was previously. That's not to say that the market is easy for everybody. There are many borrowers out there that I think struggle to refinance their balance sheet, mainly because their balance sheet isn't in a shape that is refinanceable. But if you're a big op funds or private equity fund looking to finance your latest acquisition, I think there'll be no shortage of demand, and we do a lot of refinancing work, and frankly, there's a lot of competition out there for debt. Now, the interesting point when you link pricing and deal flow is that the increased pricing has created a bit of a virtuous cycle. What we had in, I don't know, 9, 10, I guess when the crisis was much more prominent and everywhere in Europe, the general theme as a blockage to transactions was people saying, look, the banks aren't marked, the big offer spread is too wide, deals are not happening. 2 things have happened. Time has gone on, many more provisions have been taken. You'll have your view as to whether it's sufficient or not, but many more provisions have been taken, and prices have gone up. The result of that is a bid offer spread is much narrower than it used to be, much easier to reconcile, ergo many more transactions increase. And I think if you look at the transaction volume I talked about earlier, I think that's one of the points we touched on a year ago, which has generally materialized. The third point is I think less well covered by the press, is the type of transactions we are seeing coming through this distressed and opportunistic wave is quite diverse. People normally talk about distressed as REO portfolios being put on the market by banks, non-performing loan transactions. Look, it's a big component of that. It's very visible. People can track it. Large auctions, many people participate in it, right? But actually, there are many more just straight real estate transactions taking place, sometimes driven by banks themselves, but I don't think that's the majority. Sometimes driven by insolvency, that's not the majority. A lot, which is harder to track, is effectively just banks saying, look, your loan has been on standstill for the last year or so. You're just going to put the property on the market now, because I think it's a good time to sell. It's not a bank's logo on it. It may not be as wide an auction. It may not be clear to everybody that's driven by this deleveraging that's taking place across Europe. But I tell you, a lot of that is happening, and that's for the value-add, secondary, tertiary corners of the market, as well as some of the shiniest property in Europe. The other point, I think, which is new, or it's certainly starting to emerge, is we have seen entire banking platforms trading. I don't think this time that has happened as yet, but we've seen Deutsche Post Bank, the London branch, trading to GE Capital. I think you all have followed the Euro transactions in the UK and more recently in Spain. This is not just distressed stuff. This is, a lot of that is for our performing loans. And what we are seeing is, on top of the deleveraging agenda that the majority of the banks and the CMBS market was pushing, you now have an overlay of a strategic objective, where basically the banks are now saying, look, whether my book is looking good in this country, or this country, doesn't matter. I'm out there. I've decided I need to go. So it can be fund management platforms, it can be performing pools. Some of it is non-real estate, but that's the key driver to transaction. It touches real estate, but it's not only real estate. And we've seen the UK, the UK banks are probably being the most active player in the German market. If you look at Nationwide selling out, Lloyds. So actually, this is not the Germans for the Germans creating the German market, actually it's the Brits making this happen. And I think a lot more of that is to follow over the next few years. The final point I was going to make, and again, maybe you've all followed that, but the ECB is, as we speak, doing a review of the balance sheet of the largest banks across the Eurozone, thing that people have called the asset quality review. We at EY are heavily involved in that, doing review for the banks, doing the review for the regulators. And we think this has the potential of leading to many more loans being reclassified as non-performing. It has the potential of, and as a result of this reclassification, greater level of provisions taking place. Because the banks won't be able to exercise the same degree of judgment as to what's good, what's bad, what the loss could be or should be. Now, it's always dangerous to speculate, particularly in processes like that, as to what the outcome could be. But if it's found that banks haven't marked the assets properly, you'll have your view, and as a result of that, they have to take big hits. A combination of things could happen. A number of banks could come to the market raising capital. We could see good bank, bad bank split. Bad bank could be funded by effectively the government, as we've seen in Ireland, or they could be done effectively internally, but that should trigger some transactions, or simply portfolios being put on the market. Portfolios of loans, portfolios of assets, that has the potential of keeping the transaction market busy. This review is due to be finished, I think, November, December, so we could see some movement on that shortly after.